October 2017 is remembered as a watershed moment in the history of Indian mutual funds as SEBI overhauled mutual fund categories. The idea of this wholesale revamp was to make funds across categories more uniform in terms of their investment mandates. That surely made life easy for investors, for they got to know what to expect from a fund belonging to a particular category. Since only one scheme could be offered across most categories, that also helped reduce the mushrooming of similar funds within the same fund house. Now, after over 8 years, SEBI has again made important changes in fund categories. These changes have come into effect immediately. Now, what are these changes and how do they impact you? What is the intention behind these changes? We will discuss this in today's video. Hello and welcome to ET Money's YouTube channel. While you may have already come across some of the recent changes in financial media, this video goes beyond the headlines. It'll help you build the complete perspective around these changes so that you are not just informed but also empowered. For ease of comprehension, this video is divided by fund categories. We will start with equity, then move to other fund categories. Now this video belongs to our playlist on fund categories. To watch other videos in this playlist, you can check out the link in the description. But before we begin, a quick update. Many of you come here for the kind of mutual fund analysis you rarely find elsewhere, rolling returns, downside protection, and so on. But knowing how a fund performs is one thing, figuring out how to use that information in your investing decisions can be difficult because each of us has our own risk comfort and goals. That's exactly why we built ET Money Select. It's a personalized shortlist of funds that stand out from 2,000 plus mutual funds, not just on returns, but on how consistently they deliver and how well they protect when markets fall. The list is personalized to your risk appetite and gives you funds for your short, medium, and long-term horizons. And for every fund, you get a simple note explaining how it invests and what drives its performance, plus an alert if the fund starts to dip or a better alternative is found. So do check it out. Okay, let's start with taking a look at what has changed for equity funds. The first change that has happened in equity funds is regarding value and contra funds. Now, as per current rules, fund houses can offer either a value fund or a contra fund, but not both. Now, they can offer both value and contra funds, provided that the overlap between them is not more than 50%. Now, many investors use the terms value and contra interchangeably, but there's an important difference between them. The value strategy is about picking stocks that are trading below their real or intrinsic worth. The idea is that as the gap between their intrinsic and market value closes, gains can be made by a value investor. On the other hand, a contra strategy takes opposite bets than what the market favors at a point in time. Such stocks may or may not be below their intrinsic value, but they are out of favor. Now, as they again come back in vogue, gains can be made by a contrarian investor. Now, this core distinction in value and contra philosophy may well be the reason why SEBI has allowed both types of funds from an AMC. Now, as of now, there are 22 value funds that command total assets over 1.4 lakh crore. On the other hand, there are just 3 contra funds available with a combined assets of about 74,000 crore. Now, that's interesting as in spite of just 3 offerings, the AUM of contra funds is about half that of value funds. And that's because of 2 popular offerings in the contra space, SBI Contra Fund and Invesco India Contra Fund. While SBI Contra Fund has assets about 49,000 crores, Invesco India Contra manages about 20,000 crores. Given the dearth of options in the contra space, you can expect more contra fund launches in the months to come to fill the gap. The next prominent change in the equity fund space is that equity funds can now invest in gold, silver, and InvITs. Now, they can invest only their residual portions in these assets. The residual portion is the part of scheme's corpus not invested in its main core asset classes, as mentioned in the scheme characteristics. For instance, large cap equity funds must invest at least 80% of their assets in large cap companies. The remaining 20% is its residual portion. Earlier, there was no specific mandates regarding the investment of residual portion, and equity funds decided on their own where to invest in it. They invested it in equity or debt or even foreign equity. Now, there is a specific direction regarding the residual portion of equity funds. Now, as per SEBI, equity funds may invest residual portions in equity, money market instruments, and other liquid instruments, gold and silver instruments as permitted by SEBI and in InvITs, subject to the ceiling laid out in mutual fund regulations with respect to respective asset class. But there is one glaring omission here. REITs or real estate investment trusts. While InvITs or infrastructure investment trusts now qualify for the residual portion of equity funds, do REITs not? Actually, REITs have already been accorded an equity-related status by SEBI from January 1st, 2026. So equity funds can very well invest in REITs within their core or residual equity allocation. Further, in the latest circular, SEBI reiterates that foreign securities will not be treated as separate asset class. This means foreign equity can also be held in the residual portion under equity. So how does this particular change affect you? Equity funds can become more diversified going ahead because they will be able to invest in debt, gold, silver, REITs, InvITs and foreign equity. They can offer some degree of asset allocation depending on the in-house scheme mandate. A FlexiCap fund will have the maximum leeway here given its core equity allocation of 65%. The next key change is overlap in sectoral/thematic funds vis-a-vis other sectoral/thematic funds or other equity funds within the same AMC. SEBI has mandated that the overlap between sectoral and thematic funds with other such funds and other equity funds of the same AMC, with the exception of large cap funds, should not be more than 50%. Previously, there was no such requirement. Further, this overlap will be computed on a quarterly basis and its calculation methodology has been specified. Now, existing sectoral and thematic funds must comply with this requirement within 3 years, failing which they will have to merge with other schemes as per the applicable provisions. Finally, mutual funds will have to launch sectoral thematic funds as per the list of sectors, themes as published and updated by AMFI in consultation with SEBI on a half-yearly basis. Now, all this has been done to possibly check the undebated growth in the number of sectoral and thematic funds. SEBI's categorization exercise of 2017 kept sectoral and thematic funds outside the requirement of one scheme per category. This resulted in a sharp rise in sectoral and thematic offerings. Of the 250 thematic and sectoral funds currently available, about half came into being only in the last 3 years. Also, if a scheme has a high portfolio overlap with other schemes of the same AMC, that may defeat the purpose of diversification if an investor holds such schemes. For instance, we check the overlap in 2 thematic offerings of ICICI Prudential Mutual Fund, Business Life Cycle Fund and India Opportunities Fund. The Business Cycle Fund has a 62% overlap with the India Opportunities Fund, while the India Opportunities Fund has a 58% overlap with the Business Cycle Fund. So, if you have both these funds in your portfolio, you aren't very much diversified. And it's not just about ICICI Prudential's funds alone. The portfolio overlap issue can be witnessed across AMCs. Now, we discussed portfolio overlap in detail in one of our earlier videos. You can watch it to understand it better and to know how you can minimize it in your portfolio. The link is in the description. The last key change in equity funds is the minimum equity allocation of dividend yield, value, contra and focused funds. Earlier, these funds had to invest at least 65% in equity and equity-related instruments. Now, this minimum has been made to 80%. Notably, no change has been made to FlexiCap funds and they continue to have a minimum equity allocation of 65%. Now, what might have been SEBI's objective behind this change and the favored treatment for FlexiCap funds? One possible objective is to make dividend yield, value, contra and focused funds more to label. Since they are strategy funds within equity funds, this revised mandate will make them take bigger bets on their stated objective, and that's what an investor investing in them would want. On the other hand, FlexiCap funds would need higher flexibility to be useful to investors. They need to be more dynamic with their go anywhere mandate, not just across market caps, but also across asset classes, and hence their minimum equity allocations have not been touched. Now let's move on to the second part of this video and take a look at the changes debt funds have undergone. The most prominent change in the debt fund space is the introduction of sectoral debt funds. These funds must invest at least 80% of their assets in corporate bonds rated AA+ and above across durations of a particular sector. The sectors specified for the launch of such funds are financial services, energy, infrastructure, housing and real estate. Now, the possible intention here is to make it easy for capital-intensive sectors to raise funds via bond markets. However, for investors, such debt funds can bring in the concentration risk, just like sectoral equity funds, as the majority of holdings will be exposed to just one sector. Any adverse developments in the related sectors can have a direct impact on these funds. The next key change is related to investments in InvITs by debt funds. Debt funds, except for overnight, liquid, ultra-short duration, Low duration and money market funds can now invest their residual portions in InvITs subject to the regulatory ceilings. Investments in InvITs can help diversify the portfolio, and the objective may be to tap mutual funds for infrastructure related funding. The presence of institutions like mutual funds can also bring depth and more transparency to the InvIT space. The next important change relates to nomenclature changes in debt funds. The nomenclature of low duration funds has been changed to ultra short to short term fund. This name change now optically places them between ultra short term funds and short term funds. Earlier also they had this positioning, only that it was not clear from the category's name. Ultra short term funds have a mandated portfolio macular duration of 3 to 6 months. Short term funds portfolio macular duration is 1 to 3 years. Now with a portfolio macular duration of 6 months to 12 months, low duration funds fall in between. Now with the name change, this positioning is clearly re-established. Apart from this, the names of many other debt categories have also been tweaked a bit. Alright, next let's take a look at the changes in hybrid funds. The first major change in the hybrid category is that fund houses can offer both a balanced hybrid and an aggressive hybrid fund. Earlier, either could be offered, not both. Now that restriction has been removed. To be sure, SEBI has not specifically stated that both can be offered, but has just removed the restriction of offering either in its latest circular. The removal of restriction suggests that fund houses can now offer both. Now, due to the restriction, most AMCs opted for aggressive hybrid funds. There are 29 such funds available currently with combined AUM of about 2.5 lakh crore. On the other hand, there are just 2 balanced hybrid funds available with a combined AUM of just 1000 crores. This can result in more fund launches in this space in the future. But what might have been SEBI's thinking behind the removal of the restriction? The positioning of these two categories could be the possible reason. Balanced hybrids seek to contain risk by investing 40 to 60% in equities and the rest in debt. On the other hand, aggressive hybrid must invest 65 to 80% in equity. So, true to their name, aggressive hybrids are more aggressive. Maybe SEBI appreciated this fact and that its earlier restriction to choose one between the two effectively resulted in near destruction of a valid category. But why did most AMCs choose to offer aggressive hybrids and not balanced hybrids? The possible reason is that balanced hybrids are not as tax friendly for investors as aggressive hybrids. While aggressive hybrids are taxed like equity funds, balanced hybrids have a debt-like taxation, which has usually resulted in higher tax outgo as compared to equity-like taxation. Now that restriction on offering both balanced and aggressive hybrids has been done away with, you can expect more fund houses in the balanced hybrid space to fill the vacuum. The next key change in the investment mandate of equity saving funds. For equity saving funds, which invest in equity, debt and arbitrage, the net or pure equity exposure has been mandated at 15 to 40%. Earlier, this was not specifically noted. This mention is likely meant to ensure that equity saving funds don't go overboard in either direction, that is, hold too less equity or hold too much of it. The earlier mandate just mentioned the overall equity or equity related exposure of 65%, which can be achieved both by high and low equity and arbitrage for the remaining part. Now, the net equity exposure has been clearly stated. Further, equity savings funds will also have to mention the maximum arbitrage exposure in their scheme information documents. The probable thinking behind this change is to ensure more transparency and uniformity in equity savings funds. The next important change relates to the use of assets other than equity and debt for the residual portion of hybrid funds. With the exception of arbitrage funds, hybrid funds have been allowed to invest their residual portion in InvITs, exchange traded commodity derivatives or ETCDs having gold or silver as underlying, gold ETFs and silver ETFs subject to regulatory ceilings. This can make hybrid funds more diverse and thus aid investor interest. Now let's see a new class of funds introduced in the latest SEBI circular, life cycle funds. Before we start discussing life cycle funds, there's an important related development. Solution-oriented schemes have been discontinued. The solution-oriented category comprises of two subcategories, retirement funds and children funds. All existing subscriptions in these funds have been stopped for now, and these funds will be merged with other funds with similar asset allocations. Overall, there are 30 retirement plans available that have corpus of about 32,700 crores. On the other hand, there are 12 children plans available managing about 25,000 crores. So the total corpus of solution-oriented funds is about 58,000 crores. This is no small sum. So the natural question that arises here is what might have caused SEBI to take this extreme step? There can be a few possibilities. Solution-oriented funds offer nothing different from ordinary equity or hybrid funds. They had a similar composition as funds but with a lock-in period of 5 years. The labels retirement and children might have been more of a marketing gimmick rather than real value adds. Secondly, these funds have no glide path as far as their asset allocation were concerned. While there were variants or plans within the same fund, the asset allocation of these variants didn't shift as per the investor's goal. Third, the lock-in period of these funds made them illiquid and investors couldn't assess their corpus even for emergencies. All these reasons may have motivated SEBI to reconsider the purpose of these funds, and the result is the discontinuation of solution-oriented funds and the introduction of life cycle funds. Let's now talk about life cycle funds. A life cycle fund is an open-ended fund with a target date maturity. It follows a glide path and invests in mix of asset classes including equity, debt, InvITs, gold and silver. If you are an NPS investor, you may already have an idea about life cycle funds. Now there are quite a few conditions mentioned by SEBI for these funds, including the tenure, number of funds, maturity date, exit loads, benchmark, etc. Let's take a look at the asset allocation of a life cycle fund with a 30-year maturity. The fund maintains a high allocation of equity until 5 to 10 years to maturity. The equity allocation then tapers and debt allocation increases. The fund can maintain 0 to 10% of its portfolio in other assets like gold, silver and InvITs. Similarly, life cycle funds for maturities of 25, 20, 15, 10 and 5 years can be launched. We will keep you updated as AMC release their life cycle offerings. However, if the concept of these funds has fascinated you, you can still explore them via NPS. ED Money helps you invest in NPS in just a few clicks. It also provides innovative solutions for asset allocation, so do explore it today. SEBI's other schemes category comprises index funds, exchange traded funds or ETFs, and funds of funds or FOFs. In its latest circular, the regulator has introduced a standardized framework for FOFs having more than one underlying fund. Under this framework, 6 categories under which FOFs with multiple underlying funds have been mentioned. Each of these have relevant subcategories with their specific mandates. Further, these FOFs and their variants can be launched under 3 options: active, passive, and active and passive. There are a number of rules mentioned for these FOFs, including those around nomenclature, number of FOFs allowed per AMC, regions or region-specific overseas FOFs, merging of existing FOFs, etc. Fund houses will have to align their existing FOFs with the specified criteria by August 31, 2026. Naturally, there are a lot of changes related to FOFs, and what's responsible for this is SEBI's loose FOFs mandate earlier, which just mentioned a minimum investment of 95% of assets in the underlying fund. This mandate was highly flexible and all sort of FOFs started hitting the market, which confused investors. In fact, about a quarter of existing FOFs hit the market in the last 1 year only. As AMCs try to sort out their existing bouquet of FOFs, you can expect a lot of activity in the FOF space in the coming months. We'll be keeping an eye on the FOF space as well as it evolves and help you make better sense of it through our analysis. Now, apart from the changes discussed so far, there are a couple of more changes that are applicable across categories. First, the scheme name must be exactly the same as the category name. Further, no scheme across any category can use words or phrases that emphasize only on the return aspect. This will help investors identify a scheme better and avoid getting carried away by just the return aspect. Second, existing schemes have 6 months to comply with the provisions of the circular. Third, mutual funds will have to disclose portfolio overlap of an equity scheme versus other equity schemes, of a debt scheme versus other debt schemes, and of a hybrid scheme versus other hybrid schemes on a monthly basis. As discussed, this will help investors avoid duplicate schemes and thus better diversify their portfolios. So, overall, a lot of things have changed in the fund industry and we'll see the changes unfolding in the months to come. To track this channel for important updates and developments related to the revised rules. And with this, it's a wrap of this video. I hope you found it useful, and if you did, please like, share and comment. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.